Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. This is the Forex Weekly Report for the week starting August 22nd, 2022. I hope you enjoy it. Before I get started into the technicals of the market, I thought I would review what happened fundamentally and give my thoughts a little bit about what may happen going forward. The dynamics of the market shifted this week as rates moved higher. The dollar followed higher and stocks moved lower, closing down for the first week in 5 trading weeks. Other catalysts came from overseas, where in Germany, the Rhine River moved below critical levels, which compounded the transport of coal and other energy to power plants downstream. In the UK, consumer confidence dipped to a record low, and the UK CPI data moved over 10% for the first time in 40 years. Ukraine and Russia had war games going on near nuclear power plants and reactors. Yields can be a driving force, especially in the U.S. and in relation to the U.S. dollar. This week we saw increases, especially out the curve. 2-year yield rose by a modest one basis point, but the 5 and 10-year yield both rose by 14 basis points. The 30-year rose by 10 basis points. The moves in European rates were even more pronounced. Looking at the benchmark 10-year yields, German yields rose by 24 basis points. France 10-year yields rose by 26 basis points, and UK rose by 31 basis points. Italian yields moved up by a whopping 43 basis points. The difference between the U.S. and the rest of the majors is that the U.S. enjoys a bit of a flight to safety flows, which are probably keeping rates under where they should be. And there is more hope for a chance of a soft landing, which further increases probably safety flows into the U.S. as well, helping the U.S. dollar move higher. The ECB is in a real quagmire as they are behind in fighting their inflation mandate. Meanwhile, summer tourist rush to Europe is coming to an end, and winter is also coming along with higher energy prices, which is likely to sap growth and lead to a recession. The only hope there is some sort of a solution to Russian/Ukraine war, which seems unlikely. This week in the EU, flash PMI data will be released along with EU consumer confidence. German IFO Business Climate Index and German GfK Consumer Climate all are more timely data that will be telling of the pulse of both the consumer and businesses. The Bank of England, in their recent monetary report released in early August, said that they are looking for inflation to rise to 13% in quarter 4 and enter a recession in quarter 4 as well. CPI inflation moved to 10.1% this week, above the estimate of 9.8%. They're well on their way to 13% and slower growth. The Bank of Japan remains on their own path of continued expansionary policy, highlighted by their yield curve control. The yen weakness reignited this week. In New Zealand and in Australia, they get whipped around by the dollar flows and the risk-on, risk-off sentiment. The RBNZ hiked rates by 50 basis points to 3%. That's the highest rate of any of the 7 major currencies, and their currency ended up being the weakest versus the U.S. dollar this week. Listening to Fed speak this week, the Fed officials have a window of weaker inflation from CPI and PPI this month in the face of a robust 528,000 of new jobs added from the most recent non-farm payroll report. That gives them the opportunity, the Fed officials, to talk up rate hikes, but keep the hopes for a soft landing with inflation coming down as well, if the trends in things like commodities and demand, maybe supply chain, can continue. The big if is if the trends can continue. Listening to Richmond Fed Barkin on Friday, he and other Fed officials this week are in the hope phase. That is important to recognize as a trader. How the winds ultimately blow is very uncertain, and that will influence the market's movements too. It's just not certain out there, and we have to recognize that as traders. But what we know this week is that the U.S. dollar was king as the pendulum of the market swung and tilted the other way from the recent trends that have seen the dollar weakness, stocks moving higher, yields moving lower. We will see if that trend continues this week. In the stock market, the major U.S. indices moved lower for the first time in 5 weeks. European indices also closed mostly lower on the week, with the UK FTSE 100 closing marginally higher, while the German DAX fell 1.8%. So what's in store for this week fundamentally? In addition to the EU confidence data for businesses and consumers, the big event will be Fed Chair Powell's speech at the Jackson Hole Summit. That will take place at 10 a.m. on Friday. That's Eastern Time. That will be preluded by at 8:30 a.m. by the July core PCE, a favored measure of inflation for the Fed, which is expected to rise by 0.3% for the month and dip to 4.7% from 4.8% in June. At Jackson Hole, the market will be keen on what Powell has to say, but the story will likely be like Barkin and others. Rates are going up. We will fight inflation to the death. We are data dependent. And did I say rates will be going up? One topic that might be introduced would be about the balance sheet as the calendar ticks to September, when the Fed is expected to up the balance sheet reduction to up to $95 billion, which would include $60 billion of treasuries coming off and $35 billion of mortgage-backed securities supposedly coming off the balance sheet each month. Since June, the monthly cap has been $47.5 billion. However, the Fed only ran down $22 billion of that $47 billion last month. The explanation: mortgage refinancings are lower, and as a result, there is not a lot of mortgage-backed bonds maturing or coming off. Will the Fed be forced to sell securities outright instead of waiting for the natural roll-off? It does not sound a Powellish type of thing to do, but if he wanted to slow the quote-unquote markets from going too far in hopes for easing in 2023, or even slow the stimulus of a potentially overzealous stock market, that may be a theoretical topic to bring up just to show the markets who is boss. The problem is Powell does not play the irrational exuberance role of chairman's past. He is more down the middle of the road, doesn't want to surprise the market, doesn't want to cause waves, and if anything is more dovish than he is hawkish. So that is the backdrop for the fundamental perspective. The technical picture in the Forex and other markets will also help to tell the story and give traders the risk, bias, and target levels. That is what I will focus on next. Well, ladies and gentlemen, I'm going to continue the report by taking a look at some of the technicals that are driving the markets. Where is risk? What levels are in play? What are biases? Things like that that go into analyzing the market from a technical perspective as we head into the new trading week. Taking a look at the euro versus US dollar. If you recall from last week, the market moved up to test the 50% retracement and this swing area up here on the daily chart. That is of the move down from the end of May high down to the low that we saw in July. 50% came in at 1.03688, and the price couldn't get above that level on two separate occasions last week and started to move to the downside. And trading this week, the market moved further to the downside, getting below the low swing area through here, which came in between the 1.09 or 1.0096 and 1.0121. That was the up and down swing area that confined the pair through here until last week, when the price broke higher, came to the 50%, and then failed and then reestablished resistance on its way to the downside. So getting below that level was the equivalent of moving above this highs right through here. The question in coming into the new trading week is, can the price stay below these levels? Can the price stay below the 1.0096 to 1.0121? That will be the key for next week's trading. We're going to need to stay below that level in order to keep the momentum to the downside for this currency pair. On the downside, the next target comes in at 99.96, let's call it, parity for the euro versus US dollar, and below that we go down to the low price for the year, which came in at 0.99515. What does this look like on the hourly chart? If we go to the hourly chart, this is that swing area from the daily chart between the par 96 level and the par 1.0121 level. Recall, we've been talking about it for quite a while. This level, I'm going to actually move it like this. This level represents all these swing lows through here, where the market found bottoms and moved up, found bottoms, moved up, found bottoms, moved up, so on and so forth in trading this week. What is key to note here is how the price fell below the lower extreme of this area, then came up, tested it again. Sellers leaned, and on Friday, and the price moved to the downside. So the bears remain in control. They're making a play. They're trying to push the euro to the downside, where we have our support down here near the parity level, and then below that the 99.15 level. So risk going into the new trading week would be the swing area. We don't want a price moving back within this range through here, and that would be a move back above this par 101.21 level, starting with par 96. We don't want to see that. As long as the price remains below that, then we have more potential to the downside. If we move above that level, all bets are off. It would be like moving back, back below this level after trading above the top side of the swing area. So that's the story in the euro versus US dollar. Stay below this area right here. Keeps the bears more in control. Let's take a look at the dollar versus yen. We'll start with the daily chart here. And what we saw going back in time, and this is important, is the bounce off the 100-day moving average. You bounce off the 100-day moving average, it changes the whole perspective of the bias from a technical perspective. We start coming down sharply, bounce off that level, move back above it, and then we stay above this swing area. This is not in the current last week that we saw, but in the week before, where the price stayed above that level, and that set the stage for the move to the upside this week. Well, I think we moved up 4 or 5, all 5 days trading this week in the dollar versus yen. And by the end of the week, we had moved above this swing high. This is the high price from June, which came in at 137 even, around that level. We moved above that level, but closed just below that level, as you can see, near the 136.80, 88, 90 level for the dollar versus yen. Let's take a look at the hourly chart. And this is what it looks like on the hourly chart. I'm going to take a broader view of this, and if we take a look at this yellow area through here, a lot of swing levels, and moves above and below it, admittedly, but if you go back, swing high, swing low, move below that level, try to stay below it here, then try to move above it with the swing low, swing lows through here, come back down into that area, and then move below it, and then come back into the area. Take a break above it on this day right here, but where do we find resistance? At 200-hour moving average, and things started to move sharply to the downside through here. Now we're coming back to the upside in trading this week. 1, 2, 3, 4, 5 days. We started the week down here below the 100 and 200-hour moving averages, moved down to test a low swing area here, and then bounce back higher back to the 100-hour moving average. The key on Tuesday, I'm gonna take a closer look at this. The key on Tuesday's trade was the ability to hold the 100-hour moving average, and that moved the price to the upside, held the 200-hour moving average here, both bullish moves, and we saw the price move higher once we got above this swing area through here. Swing high, swing high, swing high, swing high, swing high, swing high, swing high. We got above that level. It was more upside momentum for the dollar versus yen. Now we did move up to this other swing area between 136.91 and 137.15, and came off of that level, as mentioned, trading around 136.90 into the weekend. Get above this area again, and it opens up the door for further momentum. And then we go back and test this day where the market tested the 200-hour moving average at 137.50, and it opens up the door for further upside potential for this currency pair. So watch this area right here. Watch the 137.50 level on the top side, break above it, opens up the door. We on the downside, what you don't want to see is probably a move back below the 61.8% retracement. But really, this area right here, I think, is probably the key on the downside. The 100-hour moving average is moving higher, 135.29 to 135.57. Don't want to move back into that range that would be detrimental for the bullish bias for the dollar versus yen. Let's take a look at the sterling versus US dollar again on the daily chart. This is the low price from this year, down at 117.59. That's the lowest level going back to March of 2020 during the start of the pandemic. So breaking below that level opens the door for a move to the downside. During trading this week, we moved below this swing area here between 119.33, 119.72. It'll take a move back above that area on the daily chart to give the buyers more hope that the bottom is in place after coming down, testing the lows through here. Taking a look at the hourly chart, trend moved to the downside Thursday, trend moved to the downside Friday. Breaking through levels, but just as a point of reference and a trading point for you as traders, notice here how the price failed above the 100 and 200 hour moving average here, came back down, and then held resistance against it. The next time we came up to the 100 hour moving average, what did we do? We found sellers against that level. That was a key level for the week. If you would have sold against that level, you would have had clear sailing to the downside here for the sterling versus US dollar. It's finding those levels, being aware of them, understanding where they're at, and doing the trade, risking a little to potentially make more than a little. The risk on this move would have been a move above the 100-hour moving average, maybe above the 200-hour moving average. You're risking this much to make that much. I'd do that any day, or any part of that would be even a better risk, a risk-reward ratio compared to the risk all the way up to the 200-hour moving average here. So look for those trades, take advantage of them, and you'll be on your way. Let's take a look at the dollar versus Swiss franc, and this currency pair also moved up 5 straight days to the upside. If we would go back to last week's trading, and the beginning of this week, we actually started the week below the 200-day moving average, but we did find support here last week against this key swing area: swing high, swing high, swing high, swing high, swing high, swing high. That was the clue for the upside once we got above the 200-day moving average here and above this swing area through here as well. It was clear sailing to the upside for the dollar versus Swiss franc. Moved back above the broken 38.2% retracement, and trading this coming week the 200-day or the 100-day moving average, the blue line in this chart at 0.96437 will be the next key target to get to and through on the top side for more bullish bias. On the downside, we probably need to get back below the low price from June near 94.94 to turn the bias a little bit more to the downside for this currency pair. This is what it looks like on the hourly chart. Our 100-day moving average is up here. We did break above it here and here and here and here, but the momentum could not be sustained. So if we get to the 100 and move above that level, be aware that we've had failures above that level, so we need to stay above it in order to push the pair to the upside. What is key here on the downside, watch this level swing area between 95.37, 95.40, 49 as close support. We held support against it on Friday's trade on this move to the downside. Also watch the rising 100-hour moving average of 95.22. We stayed above it from really on Monday when the price moved above it through here, and we really didn't get close to it any other time during the week. Let's take a look at the dollar versus Canada. I could look at the daily chart, but this is such a mess other than the fact that maybe we held the 200-day moving average back down here, but lots of choppy action here. So I'm going to go to the hourly chart. And if you take a look at the hourly chart, this area right here, we moved above on Friday, but traded above and below it between 129.83 and 129.89. Watch that in the early week. Maybe we hold it. It's near the 50% retracement as well at 129.75. So, maybe this area right here is just close support going into the new trading week. Be aware that, again, the dollar versus Canada is very choppy, but if we're able to hold above that, there's a potential for further upside momentum in this currency pair. It's also influenced by the price of oil, and oil has been all over the place as well, so be aware of that. It's just a sloppy currency right now. currency pair, I should say. Other than that, on the downside, the 129.42 to 49 level will be eyed, as will the 100-hour moving average. I can say that when the price moved above the 100-hour moving average here, we raced to the upside. When we came back down to it, we did find support buyers against it. Also found support buyers here in this swing area, well ahead of the 100-hour moving average, but be aware of that level going forward for that currency pair. Let's take a look at the Aussie versus US dollar next. On the daily chart, like some of the other currency pairs, straight to the downside last week, risk off type of flows following the rise in US yields. Remember from last week, we closed it between the 100 and 200-day moving average, but early in the week, the market fell below the 100-day moving average, also fell below this swing area here. Lots of swing lows and highs coming through here and moved back to the downside. This area right here was a swing low going back to May, the low from the month of May. This is the low from the month of June. So I'm going to keep that area in mind on the downside between 68.24 and 68.46. Move below that level for the Aussie versus US dollar and would open up the door for getting into the extremes for the year. The low prices that we reached in July, where the market kind of chopped around down here with 67.61, 67.17, and the low price at 66.81 as downside targets. On the top side, this area through here, I should have put it in yellow, but this area right here between 69.66 and 69.93 will be topside resistance for the Aussie versus US dollar. On the hourly chart, again, we started the week above the 100-day moving average, moved below that, traded above and below the 200-hour moving average, moved below that, came to the swing area right here between, around the 69.08 to 69.19 level. And I like the fact that the price held resistance here on Friday against that level. That's going to be a close risk level, also near the 50% of the move up from the, I think it's a July 14th low. So watch this level on the top side between 69.11 and 69.20. Or 69.08 to 69.20 as close resistance. If the price can remain below that level, the downside remains clear sailing for the Aussie versus US dollar. Finally, for the New Zealand versus US dollar, the price moved higher on the RBNZ interest rate hike here, and then it was down for this currency pair. In fact, every day I think the price closed lower. For the week last week, despite the rise by the Reserve Bank of New Zealand. I like the fact that the high price on Thursday corrected up into the swing area and then found sellers against that level. I like the fact that the price on Friday came up or came down to and then tried to stall near this level right here after or tried to break back above this level right here. Couldn't get above this swing area through here. Down it goes again. So this area is close resistance near the 61.8% retracement and the swing area between 62.12 and 62.16. Be aware of those levels going forward and into this trading week. So there you have it, a look at some of the major currency pairs as we head into the new trading week. If I were to take a quick look at some of the major stock indices in the U.S., of concern is that the Dow Industrial Average moved above its 200-day moving average last week and could not sustain momentum above that level. We closed below the 200-day moving average at 33858. For the S&P index, we came right up to the 200-day moving average and found resistance sellers against that level right here. Things like that can be catalyst for moves to the downside. All we need to do is go back to this point right here in April where the price came up to the 100-hour moving average and 100-day and 200-day moving average, found sellers and moved sharply to the downside. So these types of things where the price stalls against the moving average can be catalysts for moves to the downside. So be aware for that. For the Nasdaq index, we didn't get close to the 200-day moving average. We came up further than off the lows than the other currency pairs from a percentage basis, but we fell short of the 200-day moving average. So that too is a little bit more susceptible to the downside for the U.S. stock indices. As far as the yields go, the 10-year yield, as you can see here, was leaning against the 100-day moving average for a number of days going back to the end of July into August here. We did have a few closes above that moving average, but not by much, and the price moved back below. On Friday, we broke above the 100-day moving average for yields at 2.904%. If it's able to stay above that level, higher yields tend to lead to lower stocks, tend to lead to the higher dollar as well. So be aware of that combination in the week going forward. I hope you enjoyed this video. My name is Greg Michalowski. Good fortune with your trading. Have a great week. Bye-bye.